The 2% rule doubles the bar. A property must rent for 2% of its purchase price per month. A $60,000 house renting for $120 a month. A 40,000 duplex renting for $800 a month. These numbers sound great on paper. The reality is more complicated. In 2015, hitting 2% was possible in dozens of markets. By 2024, it is rare outside of very specific pockets. You can still find 2% deals in parts of Detroit, Jackson, MS, Shreveport, and some small towns in Ohio and Indiana. But those markets come with trade-offs. Higher vacancy rates, tougher tenant pools, more maintenance, and slower or flat appreciation. A $50,000 house in Detroit that rents for $1,000 a month hits exactly 2%. But if you are spending $3,000 a year on maintenance, dealing with 15% vacancy, and the property value stays flat for a decade, your actual return might be worse than a 0.8% property in a growth market like Raleigh or Nashville that appreciates 5% per year. This is the core tension. High rent-to-price ratios usually mean one of two things. The purchase price is very low, which often means rough neighborhoods, deferred maintenance, or both, or the rent is unusually high relative to the area, which often means the property is in a tight rental market with limited supply. The second scenario is the one you want. A $100,000 property in a solid B-class neighborhood in a city with job growth, renting for $1,800, $2,000 a month. Those deals exist, but they take work to find. They are usually off-market, need some rehab, or are in emerging submarkets that bigger investors have not discovered yet. Some investors use a sliding scale. Anything above 1.5% gets serious attention. Anything above 1.2% with strong appreciation fundamentals is worth a full analysis. Below 1% is a skip unless you are buying purely for appreciation or tax benefits. The biggest mistake new investors make is chasing 2% deals without understanding the neighborhood dynamics. A spreadsheet can look perfect while the property sits vacant for 3 months, costs $5,000 in turnover, and attracts tenants who do not pay. Bottom line, the 2% rule is aspirational, not required. Use it as a signal that a deal might cash flow exceptionally well, then verify everything with real numbers.